And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Hey, good morning and welcome to the show. Of course, it is Wednesday. It's the Hump Day edition as we roll into mid-May, right? It's May the 14th, middle of the month is here. That means what? Yep, everybody's leaving high school now. So graduation's afoot everywhere. So everybody's going to be very busy this month. I get it. But yeah, we're starting to wrap up the month of May, of course. As we get into the summer months, it is the typical, the old saying of, do we sell in May and go away this year? I mean, is this going to be a little bit different? Did we front load the correction so we have a good positive summer? That's going to be the big debate here over the next really kind of couple of months. June tends to be a bit of a weaker month for a couple of reasons. It's just, and particularly when you have a very strong month of May, June tends to be a little weaker. July tends to be a pretty strong month. And then August and September tend to be the two weakest months of the year. So again, last two summers, they were pretty weak. We had a 10% correction 2 summers ago. Last year, we had the 8.5% sell-off with the yen carry trade blow up. Will this year be the same? Or will this year be one of the summers that markets do very, very well? We're going to see, right? We've got a lot of things coming on. Right now, buybacks, of course, are a very big driver of the markets. Those continue through the month of May and into June. They start to wind down about mid-June as we start the Q2 earnings reporting season. That'll start in July. So about halfway through the month of June, a lot of this corporate buying pressure is going to fade. So right now you've got a lot of tailwinds for May that's been helping markets. Very negative condition of positioning, very negative, a lot of short covering that's been going on driving the markets here. But that's kind of where we are. So big news yesterday, of course, inflation. We'll talk about this more tomorrow with Michael Leibowitz, but inflation came in weaker than expected. It came in at 2.3% year over year. It was expected to remain at 2.4%. So inflation continues to ease down towards that 2% level that the Fed's kind of targeting. But again, when the Fed says they're looking for 2%, it's actually 2.4%. They just round down. That's because inflation should grow at about 0.2% every month. And so 0.2% times 12 is 2.4%. And that's been the average inflation rate going back to 2000. So, the Fed's just looking to get back to normalcy in terms of inflation. And as of yesterday, we're really back to their target of where they want to see inflation. So price stability, employment remains okay. No real fear of recession right now. We'll see how this all works out. But, the data continues to be supportive of an economy that's growing, but at a slower rate. But that's starting to remove a lot of this recession fear. During this decline in the markets that we had, there was a lot of analysts that came out and started predicting recession. Tariffs are going to cause recession. And we really haven't seen any evidence in the data. And so the recession calls are now starting to be reversed. A month later, recession, no recession. So the analysts are now reversing a lot of those calls. And earnings estimates actually turned positive for the first time in 6 months. So, starting back in December, analysts started revising down their estimates for the S&P. That really gained some traction going into this whole tariff announcement. As of yesterday, those weekly analyst estimates actually turned back to the positive. So they're now starting to actually upgrade estimates for the markets. Are they right? Are they wrong? Who knows? Goldman Sachs came out yesterday, raised their price target for the next 3 months to 5,900. We closed at 5,860 yesterday, so that wasn't a big leap for Goldman Sachs. But they are predicting the next 3 months the markets will be 40 points higher than they closed yesterday. So I don't know if you make a bet on that or not, but at least that's where they are. So a lot of stuff that's been going on, right? So, a lot of talks, lots of headlines. Now everybody's trying to figure out, what does this mean now that we've got a trade deal with China? What does this mean now for these other countries that we have trade negotiations with? What does this mean for the markets? And everybody's turning a lot more optimistic here from very, very negative levels. And again, we talked about before, a lot of people really kind of poo-poo investor sentiment, and we said we're back here on April 6th we wrote that article called "The Hope in the Fear." It's on the website if you want to go back and look at it. We talked about this very negative sentiment and that normally coincides with market lows, which was exactly what happened. And again, that sentiment is now starting to slowly turn positive. We're starting to see indicators start to get more back into the greed factor, and again, with markets that's, kind of where you want to start looking at, taking some profits and kind of rebalancing some risks. Markets don't go straight up, they don't go straight down, and this has certainly been evidence of that. But here's what you need to know before the bell this morning. Yesterday, the market turned positive for the year. So if you'd been Rip Van Winkle and went to sleep in January, came back and opened your account yesterday, account was flat for the year. You didn't see any of this big decline for the markets, but markets actually positive for the year as of yesterday, just barely. We're up 0.8%, but we are positive for the year. So, that's at least saying something. Importantly, though, we have cleared all these major levels of resistance that we talked about yesterday. So that really doesn't leave a lot of overhead resistance for the markets to get back up to all-time highs. And I know that seems like a stretch right now for markets, and at least if you've been, kind of betting against this market a bit in a way, or been worried about, hey, this is, we're finally going to have this big correction. The market's really starting to defy a lot of that. Again, every kind of resistance level has given way to what's happening underneath the surface. And here, let's talk about that, because that's the big driver here. You have professional investors that are very, very far behind in terms of allocations. They got very negative back here in early, kind of really, late March, early April. They started getting very, very negative on positioning in the markets. And so they're very underweight equities. We saw them selling a lot of the Mag 7. There was a lot of talk about, the Mag 7's dead. You don't want to own them. They're overvalued, et cetera, so forth and so on. So there was a lot, and professionals are all selling them. The hedge funds are selling all their Mag 7 stocks. Get out now, right? That was the big story. And now, unfortunately, they are very underweight those areas. And the one big problem with being underweight the Mag 7 in particular is because of their position weighting that they have in passive indexes. So when retail investors started coming back into the markets here and started buying a lot of S&P index funds, the QQQs, the NASDAQ funds, the mega cap growth index funds, those all have big weightings of those Mag 7 stocks. So all those dollars flow right back into those equities. And now that those prices for stocks like Apple and Microsoft, Palantir, NVIDIA yesterday, NVIDIA and Palantir have had two fantastic days in a row. As those prices rise, those professional managers are now having to buy those stocks, trying to cover their short positions, buy those stocks. So all of a sudden now you're getting a lot more money flows coming back into the Mag 7. And in fact, during this entire rally, the biggest winners in this entire rally were semiconductors, the Mag 7, followed by the NASDAQ triple Qs, right? Which is all heavily weighted in those Mag 7 stocks, and they have outperformed to a large degree here relative to the S&P index itself. But the important part about this is, again, you have in those big mega cap companies, you've got a lot of negative professional sentiment, negative underweights in those professional allocations. Those are having to play catch up now. Big short positions on a lot of these on the markets, as well as a lot of these stocks, that's having to get covered. And these are the companies that are buying back their shares. And there's been a very strong surge in buybacks over the course of the last 4 weeks. So since earnings season has ended, we've seen about a 12% jump in buybacks, going from a negative 10% decline. So you've had a very, very large reversal in those corporate buybacks. That's a lot of money flows into those stocks, and that's been driving a lot of that group of stocks higher. And again, that will fade here. Markets, again, we're back to very, very overbought conditions of both momentum and relative strength. You're going to get some consolidation or a pullback here. But again, as long as we can maintain this kind of recent support level that we've got in the markets are going to try to work their way higher here, at least over the rest of this month. So again, that's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff, talk about should you add 4 times leverage to your 401k plan. We'll talk about that after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And good morning. Welcome to the show. It is, of course, Wednesday. That means Danny is here this morning to join me.
Good morning.
How you doing, Danny?
Good.
Kind of an interesting, so just talking a little bit about the markets. If you had just, we had talked about before is that over the last, over the month of April, we had, a lot of people emailing us and calling us, et cetera. And it's like, oh my gosh, I got to get out of the markets, the market's declining. Interesting is that if you, I was just talking about this a second ago, if you had just, turned off everything in January, opened everything back up, the market's flat for the year. So, all that angst in the month of April and the first part of May now gone, and markets are back to, floating positive here for the day. Again, we'll see what happens, but it's very interesting how investor sentiment has changed so quickly from, all out panic for the most part back to now we're getting calls saying, okay, how do we get back in?
Well, and I think that's the biggest challenge right now is that we need a degree more in finance and technicals and everything else. Instead of that, we actually need one in psychology because investor behavior and the psychology behind it is so real. And you've talked about that, anchoring and recency bias. And it goes from one end of the spectrum to the other where we've had a handful of people who are very, very conservative. And I get it. We understand this is your livelihood. This is something you've worked your whole life for. And you want to make sure that everything works out well. And when things go down, we have that tendency to either fight or flight. And unfortunately for many, flight is the number one thing they do, but they usually do it too late. And then on the flip side of that, once things get better and improve, that's when they want to say, hey, let's get all in. So I can't tell you the amount of conversations we've had with, and it's not everybody, it's a handful of people. But I know there's a lot of you out there that experience the same thing because it is emotional. And unfortunately, we let our emotions get the best of us where, a couple of weeks ago, we would have said, hey, we just need to get all out. I can't find any reason for the market to go up. There's nothing good that's going to come from this. And, what some of our discussions have been around, I understand your sentiment and your feelings behind this. However, if we get a trade deal done, if we get any type of good conversations going on, specifically with China, we could see this turn very quickly. And then obviously this weekend happens. And now the phone calls and emails have changed where, hey, Are we too conservative now? Do we need to be invested more? and yeah, you could say that if we're going day by day, but where are you? Are you better off now than had you rode it all the way out by being prudent, taking some profits along the way, staying the course unless something dictates we need to reduce exposure further? Because many of our clients specifically, they're not all in right now. They have cash on hand. They have dry powder available to purchase things. And there will be opportunity, but we're not out of the woods yet. And I think that's what everybody believes is that, it's only going to get better from here now because we've had that discussion.
Right.
And that may be true, but what type of economic pain has already been incurred that we just haven't seen yet?
Well, and there is that risk, right? And certainly, the one thing for the markets is markets are forward looking.
Correct.
So they're going to be looking, down the road. In fact, I was having this debate on Twitter this morning because our Bull Bear report this weekend is talking about recession odds. And all of a sudden, there's been this massive reversal in recession odds. Everybody was starting to claim, a recession's coming. And now all of a sudden, they've just completely gone away. And everyone's like, oh, no, everything's fine now. And so the debate is like, well, yeah, you don't know that, though, because we haven't seen the revisions to the data. And, well, the problem with that is that, let's say that, yes, next year, the National Bureau of Economic Research comes out and says, oh, yeah, first half of 2025 was a recession.
It's already behind us.
That's the problem.
Yeah.
It's already behind us. The markets have already moved on. And so the whole problem with betting on a recession and those type of things, you better be accurate in your timing and the data better support it, because if you don't time it just right, if this 20% decline in the market was coincident with the onset of a recession that we'll know in a year, then, because you're always 9 months later to find out it's a recession. So by the time you get that announcement, you say, "Oh yeah, that I timed it perfectly, right? That's great. Pat on your back." For everybody else, you're going, "Okay, well, there was a recession. Why isn't the market going down now?" Well, because the market's already priced that in.
Yeah, the market knows, and that's what I
Yeah.
tell everybody is that the things that we can write down right now, we make the pros and cons list. The cons list at all times will be much larger than the pros.
Mm-hmm.
It's very seldom that you'll see it the opposite.
Right.
However, the market knows about each and every one of those cons. And so, I tell people what keeps us up at night is what are the things that we don't know? What is out there? You call those exogenous events,
Right.
the black swan. Those are the things that scare us more than anything, because that's something that you just can't really account for. And, the challenge as well is that there's so many compelling arguments on both sides. There's a lot of compelling arguments to be bearish. There's a lot of compelling arguments to be bullish. And you have to take most of this with a grain of salt, because what are they doing? Are they talking their book? Have they always been bearish, or have they always been bullish? Having somebody that can kind of give you both sides of the coin, I think, is extremely important. And, I think that we can gain a lot of different information from different viewpoints. But at the end of the day, making an all or nothing decision many times backfires on people. Mm-hmm. And I think understanding, okay, hey, let's begin to step back in. If you're hedged, maybe to begin to take a hedge off. But, this all or nothing is really, you hear about, this guy called it perfect. Yeah, but he's been calling it for 10 years.
Yep.
One way or the other, bullish or bearish.
Yep.
But what if you made a decision based on that at the wrong time and you're completely off sides? Because we still, and I'm hearing once again from people, which is interesting. We talked about, people that are invested in the market wanting to get much more conservative, then wanting to get more aggressive. And what we do find is that over long periods of time, they typically underperform our model. And because we're getting out at the wrong times. But the people that are going with the strategy of, now I want to get back in, are the same people that a couple of weeks ago didn't want to do any of that. Right?
Right.
So it's like the people before who got out in 2008 saying, hey, it's 2020. I've been out of the market. I need to begin to step back in. Those same types of conversations are now being had.
Right. And again, it's really fascinating to me because, again, as I was mentioning in the first segment, I wrote that article called "The Hope and the Fear," which was right on April the 6th. So the bottom of the market was April 7th, by the way. But that whole article was just driven by looking at the super negative sentiment of investors, the technical extremes of the markets. And it's very unusual that you get that much negativity all aligned at one time in the market simultaneously.
Yeah.
And that only occurs at major market bottoms like We saw it in 2020. We saw it in back during 2008. It's very rare to see it that deep and that negative. And that's and again, it's just such a great contrarian indicator that you almost just can't ignore it. And it's scary at that time, right? I mean, April the 7th, this market's down 19.2% from the peak. Nobody wants to buy anything, but that's where you've got to knuckle up and start saying, okay, we're going to add some exposure to the markets. Even if you're wrong and the market goes lower, you still bought some stuff at cheaper prices. And that's the thing that investors tend to forget, is that our whole goal is to try to buy stuff cheap, but that's exactly when you need to be buying is when you want to be selling. Yeah. And that's so hard to do.
That's the number one rule of investing, right? Mm-hmm. Buy low, sell high, but yet it is the hardest one. And everybody knows it. We all know it. Every one of you out there knows exactly that. But it doesn't just come with, stocks. It's real estate, anything else. For many people, that is the biggest hurdle to overcome. And, I don't see that going away anytime soon. That's just human nature. But that is when you want to inevitably be buying. But the problem is we all think, and we also know, hey, this could get lower. It could get lower from here, which is why you can't just say, hey, I'm pushing every chip into the middle of the table right now. You got to do so thoughtfully.
Yeah, exactly. And, now we're getting, and it's interesting now, we're starting to see all that sentiment reverse and now become much more bullish. And we're not to extremes yet, but it's not going to take much more of a rally to get consumers and retail investors, et cetera, back to more extreme levels of overconfidence in the markets. And again, that's where we're going to start talking about, hey, time to really take some money off the table here, because this is where, we're typically kind of form tops. But again, this is just how market dynamics work. But it's been a fascinating experience or experiment. And looking back, here just in recent time, I mean, it's, you just see the same kind of investor mentalities play out. And what was really interesting about this time, really over the last, I'd actually back that up and say really ever since 2020, what's been fascinating is that retail investors have been, buying dips more so than professional investors. And just like we saw here, retail investors were in buying this dip, expecting this market to go right back to highs. Professional investors were hedging, getting out, going short the markets. And now they're having to play catch up to the retail investors. So it's been interesting to see all this, kind of this change in dynamics. Retail investors are becoming much more aggressive about investing in markets.
It is interesting. Sometimes maybe it's somebody knows too much, right? You know what can occur here. And I think that's one of the things that any professional money manager has to think about, and any retail investor as well, is that the preservation of capital. And, the math of loss. We talk about it often. And we know this thing could deteriorate once again. You could get one bad, piece of news. You could say, oh, the China-U.S. deal's blown up. And what happens? Oh, yeah. And that is the problem, trading basically headline to headline to headline. And, the other thing that we've talked about in the past is that markets are moving so much quicker, and a lot of times are moving overnight specifically. It used to be you could wake up and markets would be up slightly, and then boom, they go to the moon. Yep. Now you wake up, the markets are up quite a bit, and then trading seems to taper off a bit, right? Yep. Or a little bit of sellers come in at the end of the day. So it's been different, not to mention the cycles haven't been a typical cycle. You get a bad year, significant downturn in 2020, then you get up, 21, 22, you're down, everything's down, 23, 24 is up, market breadth's pretty light, right? And now, we're facing something similar again.
Yeah, exactly. All right, we'll come back. A new 30-year-old has come out with a new startup that will let you put 4 times leverage on your 401k plan and do private credit all at the same time. Good idea or not? We'll talk about it with Danny. We come back. He doesn't know anything about this, so we'll talk about it with Danny when he comes back, get his first reaction at adding leverage to your 401k. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm a little disappointed. I was expecting Crocodile Dundee to come back from this trip and have alligator tooth necklaces or some tribal tattoo, where he was adopted by some tribe.
The Real Investment Show podcast.
You don't know what I'm wearing underneath this suit.
Same show, your schedule.
You didn't come back married to some tribal princess or something?
No, I did not. Yeah, I can barely keep up with one, much less multiple.
At realinvestmentadvice.com.
They must have some really good time management.
Exactly.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover, or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So Bloomberg recently published an article talking about this 30-year-old startup is bringing leverage to 401k savers. What this article details is a company called Basic Capital. It's a new startup providing, I'm reading this for you, providing institutional investment strategies to individual 401k and IRA savers. Basic Capital allows clients on its retirement savings platform to use up to 4 times leverage. For each dollar saved, its investors can borrow $4. Basic is currently charging about 6.25% to borrow the money. Moreover, to further boost potential returns, they can help participants in private credit investments in addition to more traditional stock and bond assets. And this was a quote from the article. But the thinking goes, the startup can find private credit investments from the major players in the industry that yield more like 9%. That's about average for a private credit investment, meaning they will throw off enough cash to cover the borrowing cost and then some. So in other words, if you're borrowing at 6.25% and you get 9.25% on your private credit investments, you get a 3% spread. Right, so you're going to make 3% on your money. Mix in some traditional stock and bond exposure, and assuming those private credit yields persist and that equities gain in line with historical averages, the startup says savers can expect low double-digit returns. So this is interesting, Danny. So I can add 4 times leverage to my portfolio, buy stocks and bonds, throw in some private credit there, And I'm doing this on 4 times leverage, and I'm only getting low double-digit returns. I can get low double-digit returns just by buying the S&P index fund. It was up 20% 2 years in a row. That's a low double-digit return. So why do I need to take on, kind of this excess leverage, in my 401k, which is, by the way, that's for most people, that's all of their retirement money. And so if something goes wrong with that, that's all they have saved up for the vast majority of people.
Well, because it's sexy, Lance. And it sells stuff. Here's the problem with this. Number one, if this is your only way to access something like this, that doesn't mean it's right. And, that's why many of these funds, if you want to go get into a private credit fund and you want to get into just any of these private equity investments, you need to, number one, typically be an accredited investor. You need to have some experience. Now, I know there's a lot of different ways that you can get out there and have access to this, but most of these, especially quote unquote retail spaces, how are they going to offer this to you at, $10, $20? The headache from a legal perspective, right? With all this. The compliance aspect behind this has to be awful, number one. Number two, what is in it for them is what you need to be thinking about.
Well, they're getting a fee, plus they're making 6.25% on the money they lend you. Yeah.
But they're also probably taking a fee on top of whatever you're making.
Sure, absolutely.
And which is not uncommon. But I don't like this in the sense that I think people need to learn one thing, learn it well, then begin to, as you accumulate assets, then your kind of investment options begin to broaden.
Right.
And, the liquidity issues, the leverage aspect of this, if something does go wrong, is tremendous. And you're talking about not just wiping out a little bit of somebody's net worth, but a lot of it, or potentially all of it, by taking undue risk for something that, I think what a lot of people want to be able to sit around the dinner table and say, well, man, I'm in this new private credit deal or private equity deal, and it's great. And it's a great talking point. And, maybe it makes people feel good because I think for whatever reason, it has been, kind of the higher echelons of net worth are typically doing so. But yet they're not putting all their money into it.
Right.
And they still have stocks, bonds, cash. So if you have everything else and the foundation set up already, great. But I'm not sure I'd still want to be doing it in there.
Right. Well, again, there's, as we've talked about before. So first of all, let's cover a couple of questions you asked, right? So what does basic capital get out of this? So Michael Leibowitz did some analysis on this whole strategy, and he created this graph for you real quick, and Brent will bring it up. But what this graph assumes is that the portfolio uses 4 times leverage. The calculation includes the 6.25% interest expense for the leverage, but not basic capital's management fee or the 5% it charges on the gains upon withdrawal. So when you take your money out of the 401k plan, Basic charges you 5% on your gains. So that's how, so you were asking what does basic capital get out of this? But here's the trick to this, is that if based on just the 6.25% fee on the leverage, and you're using 4 times leverage in your portfolio, if your portfolio declines by 15%, you get margin calls, you're wiped out. So we just went through a 19.2% decline in the markets. You would have not, your 401k would have not survived that 19.2% decline of the market. You would have been wiped out at 15% because you would have had margin calls. So that's, and so this is, one of the things we talked about before is that, we encourage you to invest, and we encourage you to, you can invest aggressively. That's great. Do that in a taxable account. Open up an investment account at Fidelity or Schwab or wherever your personal choice is. Open up an account and, buy your stocks, make your aggressive trades, do it in a taxable account, because at least you can write off your losses when they occur. And they're going to occur. We're all going to lose money from one time to another. So you want to be able to take advantage of those losses. In your 401k plans, your IRA, that's your retirement money. That's the money that needs to be there when you retire. You should not speculate with that money. right? That should be very conservative investments, grow it over time, contribute to it regularly, because you don't have the ability to add, the advantage you have with a taxable account is that if I lose 30% of my money, okay, I can go take some money out of another, savings account or whatever, stick it in, and I can get myself back to going again. I can kind of feed that account. You really can't do that with a 401k plan. I can dribble some money into it every year, but my max this year, Danny, is what, $23,000 if you're over the age of 50? What's the limit this year?
Under the age of 50, it's 31.5 if you're over.
Okay.
So,
but it's not a lot.
But it's allowing you more purchasing power essentially in this. So imagine you put $100 into this account.
Mm-hmm.
They're going to finance you $400. So you're going to essentially get $500. Now your hurdle rate on this is you have to make more than 6.25. But wait,
plus the fee.
There's another catch, right? The 5% fee plus they charge a 0.5% management fee on top of it. So the management fee is 0.5, and from what I can tell now, like Lance said, I'm literally just putting my eyes on this. You're paying them to manage the funds plus a percentage of the gains plus the money that they're lending to you. So technically, if you're at 6.25, you have 5, right? You need to make 11.25, not to mention, so 11.75 with their management fee for you to make any money. Now, what they're going to tell you is that's great because you're borrowing that money, that 4%, right? That additional, so if you have 1%, they're going to give you an additional 4. Now you have 5% of leverage. Just make it super easy math. So you have to make over 11.75% for you to actually come out on top and not owe them money.
Right. That's the problem with this. And again, that's
what a deal.
That's why my whole point though is that, and again, here's the other question I have is how are they actually doing this? Because you cannot draw margin on a IRA account or a 401k plan because of ERISA guidelines. I can't go to a bank and pledge my IRA for a bank loan because of ERISA guidelines. How are they providing 4 times leverage in an ERISA retirement account?
I don't know. I'm gonna have to look into this more.
I'm just curious how they got that past the regulators.
Oh, and there's $25 a month.
Oh yeah, no, the fees are incredible.
Yeah.
It just if they can sucker some people into doing this, they're going to make it kill it. This is going to be great for them.
I mean, clearly they've done something right. I mean, it's it seems to be something people like. Well, and I understand. So this is where they're going to really do well. You're going to have somebody who says, you know what, I have not saved enough for retirement.
Mm-hmm.
I am going to go, you know what, this is a great idea. I'm going to go and leverage these funds because I need to get more aggressive in these last several years before I retire.
Yep, exactly.
And that's where they're going to do well.
They will do well.
Our conversation.
As long as markets go up, they'll do great.
Yeah, if it's the longest markets go up, and that is the key factor. And so we do have people who call in and they say, hey, you know what, I need to do exactly that. I need to get more aggressive. I wasn't able to save as much. I need more money in retirement. And I need to be super aggressive. And my conversation with them would always be, okay, great. What if the market goes up 20%? Is it life-changing? Well, no, probably not, but it's really good. I can take a little bit more money out.
Mm-hmm.
Okay. What if it goes down 20% and now you retire or you're forced to retire? Is that life-changing? Probably, right? Especially if you were already underfunded. Now, if you're funded well, and like if you're somebody we're working with, we're already making those assumptions. When you go into retirement, we're going to see 2 negative years of returns those first 2 years. We want to play devil's advocate. We want to understand that. But for somebody that may already be underfunded, this is the problem I see with a lot of these. I'm not saying this is a get rich quick deal because it can be the opposite and can be get broke quick as well. I mean, very easily, right? I mean, it doesn't take much.
It takes a 15% decline. You're done. There is no coming back from that, right?
But even if you only make 5%, you're still owing them money.
Yeah, of course. Well, I know that's the whole question, which is, this sounds like a really, look, I've been in this game for over 35 years now. I've seen a lot of this stuff come and go over my years. None of this stuff ever works out. It sounds great. And when we're in a rip and bull market like we've been in for the last 5 years in particular, these ideas are fantastic, right? Everybody's making money. The markets only go up, buy every dip. It all works fine.
really, I said the last 5 years, last 15 years, it's been this way. We've educated this whole group of people just to be super aggressive in markets. That does end at some point.
They call this mortgage for retirement within 401k plans.
Mortgage your retirement. I like that.
Mortgage for, but you might as well say
it's
your.
a mortgage. You're mortgaging your retirement.
Yeah.
All right, be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Of course, get ready to wrap things up. Recently, we had Candid Coffee and with Danny and Richard. Had lots of questions coming in that didn't get answered during that event. And Danny had a few that you wanted to ask me today.
Man, I'm still thinking about this basic capital here.
He's going to be wrapped up in that all day now.
No, I won't. But no, so we always get a ton of questions. This time was no different than others. But I don't think I wasn't available this Candid Coffee, so Richard and Michael Leibowitz did it.
Yep.
And we didn't get a chance to get through a lot of these. I know y'all had a lot of questions online during the event, and that's what it's designed for. But a couple of things I thought were interesting. And, one of the things that it's a consistent theme, and it's something that you and Mike could probably elaborate and spend a lot more time on tomorrow, is, bonds right now.
Right.
Has anything changed, and what will change our thesis on bonds if we see things fundamentally change? And what I mean by that is, and we actually had this discussion yesterday, was what if we do bring manufacturing back? What if we do spark growth and inflation all at once? Will that change the thesis on bonds, especially particularly longer, intermediate to longer duration bonds?
Well, so
now, Grant, I think that's 5 to 10 years away at its earliest, right? If all those things came to fruition.
Yeah. So I mean, but let's just play your game for a second and just say hypothetically tomorrow we wake up, right? And manufacturing is now returned to America. We're now back to 80% manufacturing, so the 70s, right?
Yeah.
80% manufacturing, 20% services. So let's just say we flip it around, we're back to 50-50, right? Because now we're 20% manufacturing, 80% services. So let's just say tomorrow we wake up, we're 50% manufacturing, 15% services. you're going to get 4 to 5% economic growth. Wages are going to rise, and inflation will rise to track along with economic growth. So you have 4 to 5% inflation. Bond yields will need to be 4 to 5%, right? Somewhere in that range, maybe 5.5, because you need a slight yield over premium with your bonds, right? So over inflation, slight premium. So so if you can get back to that environment overnight, then that's great. Who cares? That's awesome, right? So now I'm getting 4.5 to 5% on bonds. I buy bonds. I'm making 5% a year on that. So if I buy a bond today, hold it for 10 years, I get 50% back on my money, right? So that's no big deal. And I'm getting stronger economic growth, which means my wages are going up, which means my my lifestyle is improving because I'm being paid more, right? So that's fine. That type of environment's fine. Back in the 60s and 70s, we had 8% growth, 8% inflation.
But wage growth was right there with
8%. Yeah,
and that's the biggest difference.
Exactly. And so I mean that would be if he can make that occur, that would be fantastic.
Well, but we're also assuming that we are. I mean, here's what I think the struggle is going to be, in the sense that you're going to bring back jobs. You may have more people building the factories, the facilities, the warehouses than you're going to have working in them, because to be competitive.
Well, hold on a second. You're making a lot of assumptions. You're going to bring back a lot of jobs.
Well, that's what I'm saying. That's what I was getting. You're probably have things that are done more on robotics, because if you want to be competitive, you can't pay the union workers. You can't pay all the people that are going to require health insurance and what they're not currently paying overseas. And so that's, I think, is going to be something they're going to have to deal with as well. So you may not have nearly as many jobs, but you have actual manufacturing here.
Right. Well, no, yes, to some degree. But most of this is going to be reshoring. So you'll move it from China to Vietnam, or from Vietnam to some other country where they have cheaper labor. And so we'll move manufacturing around, but it doesn't necessarily mean that we're going to bring it back. And again, the jobs that we do bring back, again, will likely be largely replaced by AI, productivity enhancing investments, et cetera.
Yeah, but isn't the whole premise behind this kind of a national security, national defense aspect as well? Plus, not only controlling our own destiny in the sense of building things here, right? It sounds great. And that's what they keep telling us, right?
Yeah.
But it's just going to be from China to Vietnam or India or wherever else.
Yeah, because look, at the end of the day, businesses are in it to make money.
Yeah.
Right. So
of course.
Right. So, and this is the problem that we have, is that we have I had this long conversation with Adam last week about housing. Right. It's like, oh, housing's so unaffordable today. It's versus what it was back in the 60s and 70s. So back in the 70s, the average wage was about $10,000 a year. Right. You could buy a car brand new off a showroom lot for $6,500. But that was expensive back then relative to the wages that people were making. And, you look today and it's like, well, housing's so expensive, people can't afford to buy a house. Well, the expectations are so different today for home ownership. Back in the 60s and 70s, our house was 1,100 square feet, nothing fancy, 1 bedroom, 3 bedrooms, 1.5 bath. That was it. Now you ask, and so if you ask a kid today, right? You ask somebody in their 20s or 30s today, it's like, oh, you want to go buy a house? Well, here's a house. It's 1,100 square feet, no frills, right? Just basic house. Get you into this house for, $150,000 a year. $150,000, right? So your mortgage payment's very reasonable. It's 20% of your income, so forth and so on. They don't want it, right? I got to have, nice, I need to have everything in my house that I see on House Flippers, right? This knocked out chef style kitchen and 2-car garage and all this other stuff. And then I've got to also have the latest iPhone, the latest computer, the latest, the fastest internet connection. I need all this other stuff that nobody needed to have back in the 60s and 70s. Right? If we wanted to communicate, we put mail in the mailbox, and the postman picked it up and took it away, and it somehow got to where it was going at the end of the day. So expectations are so vastly different. And so the problem for companies is great, and this is the point you made, is great. You want me to reshore jobs. I got Wall Street breathing down my neck saying I have to make X in profit every year in order to keep my stock price elevated. So I can't afford to pay the wages that people want to be paid here. I can't afford to pay them wages plus their benefits plus, paternal leave, maternal leave, this leave, that leave, personal time off. You don't want to work, but you want to get paid a full year salary. Can't afford that. So my only choice is labor is the most expensive aspect of any business. So my choice is I have to find that lowest cost of labor, which is either going to be automation with AI or offshoring it to some other country. They can do it for cheaper. And this is what we've been doing for the last 40 years. And I think the dream is we could bring manufacturing back to America. We could start making blue jeans again and televisions again and all this stuff that we used to do. I think that's a great dream. I just don't know how you achieve it fundamentally because of the profit motive that's driving the consumer-based economy.
Yeah. You see that video by Mattress Mac? He posted this last week.
Yeah.
You saw it, Brent? Yeah, talking about basically how, all these, we used to have so many furniture makers in the United States. And then all of a sudden private equity comes along, starts scooping them all up, making one big, large fund, and then basically offshoring all the jobs. Yep. He's like, well, that's a problem with the fabric of America. It's changed, right? We used to have, you could have a one income household. Now it requires two. The nucleus of the family's been broken up, and people don't have that sense of purpose. But while that is noble and great, and I agree with it, it's because of the way the markets work and the environment that we're in, it's going to be really difficult to get done, right? I mean, to bring that back, to flip that switch, because is somebody out of the goodness of their heart basically going to say, okay, guys, we want to hire Americans again. We're willing to pay more and bring all those jobs back? No.
Well, that's great, but then it's still...
But it's not affordable. You can't sell it. It's not a profitable business. It is a charity at this point.
Exactly. That's the whole challenge. And again, the expectations we have today, versus what we had back in the 60s and the 70s are so vastly different because I have to have, phones and computers and all this other stuff. And I've got to have nice cars and nice houses and all these type of things. Our expectations for what we determine to be a middle-class lifestyle has just gone off the rails over the last 20 years because of doing things like adjustable rate mortgages, 0% interest rates, no income loans, no money down loans, all this consumerism that we've driven in the economy. We've taught people to have, you should expect to have, it's your right to have all these really nice things because you can do it on credit. Yeah. And so look, like I said, the dream is fantastic. I would support any efforts to bring back the manufacturing base to America because it will make America so much stronger if we can control our own destiny in terms of manufacturing, production, those type of things. I just don't see how you get there, right?
Yep.
And because there was, we talked about last week, is that artificial intelligence is great. It's going to increase the per capita GDP of America. That sounds great. Well, the problem is it only increases the per capita GDP of those using the AI for profitability versus everybody else that's not having a job now because of AI.
Yeah.
Right?
So that per capita GDP goes up exponentially, but it's not
very divided.
It does not level the playing field. It actually makes that divide worse.
Exactly.
Yeah.
See, and again, look, I don't have the answers at all, and I'm not saying I do. I'm just saying is that we've done a lot of stuff over the course of the last 20 years, starting with Alan Greenspan, that has really devastated the middle class and lower. Everybody from the middle class down, they've been devastated through more debt, more less wealth growth, those type of things. And again, this is why we have this big wealth gap in the U.S., which is a problem. But I don't know how you fix that.
I don't either. And the argument is, I saw yesterday they went to Trump and said, "What? You're not a big fan of the millionaires tax?" He's like, "No, because it hurts everybody," and it does. But that's the problem is that some of these guys made really tough decisions along the way to get to where they are. We've seen them, we know them. But on the flip side of this, it's woe is me.
Yeah, no, I agree. Wish I had the answers. Don't.
Me too.
All right. Wraps up the show for today. Be back tomorrow with Mike Leibowitz. We'll get all into the inflation numbers, what the Fed does next, and markets now pointing slightly higher this morning. So let's see if we can lay onto this rally some more today. NVIDIA is going to be up again today. So we'll talk about it tomorrow. See you then.